Silver isn't T-rallying because people suddenly feel bullish. It is rallying because the physical math is getting tight and the paper market is starting to flinch. And the funniest part is how hard the mainstream tries to frame this as a mood swing, like silver just woke up emotional. No, this is structure. This is constraint. This is a market discovering in real time what happens when everyone thinks supply is somewhere. But deliverable supply is not where it needs to be when the clock forces decisions. And by the end of this, you're going to have a clean practical map for the next week. What level actually matters? What confirms the thesis, what would weaken it, and the one hidden signal that tells you whether this is a controlled trend or a liquidity event waiting to happen. Because that distinction is where money is made or lost, even if you're directionally right. And that's where the real pressure starts. Let's pin the context to something concrete, because silver loves to weaponize vagueness. In January alone, silver didn't drift. It lunged. It ran from the low 70s to above $100 at the highs. That's not the kind of move you get from a bit more optimism. That's the kind of move you get when liquidity thins, positioning shifts, and the marginal buyer stops negotiating. Price jumps not because it's fair, but because it has to. And the moment a market starts moving like that, you have to stop looking at headlines and start looking at plumbing. Spreads, inventories that can actually deliver, and the behavior of the biggest pools of metal exposure. Because if you only look at spot, you're basically watching the shadow on the wall, not the object casting it. But that's not the part that matters. Here's the conflict you need to understand right now. There are forces in this market that benefit from silver being perceived as liquid and abundant, not a cartoon villain. Incentives, risk management, narrative stability. A market feels safer when people believe there's plenty of metal and it is all priced efficiently. The problem is, tightness doesn't show up first in the headline price. Tightness shows up in the places most people never check, because those places don't trend on social media. Tightness shows up in spreads. Tightness shows up in delivery behavior. Tightness shows up in what category of inventory is actually available to meet demand this week, not what exists in a database as total. And when those signals start leaning the same direction, price follows like a magnet, but only after the quiet signals have already moved. That's the hidden detail most people miss. So let me give you that hidden detail cleanly, because once you see it, you can't unsee it. The market keeps quoting total inventory as if it has a single bucket of silver that can all be mobilized on command. But the fight is over deliverable inventory. What can actually show up when someone demands metal on schedule, in the right form, in the right place, under the right rules? Think of a warehouse with two doors. Behind one door is metal that is registered, deliverable, ready to meet a contract obligation with minimal friction. Behind the other door is metal that is stored, held, and accounted for, but not committed to be delivered. It might be owned by someone who has no incentive to sell. It might be pledged. It might be sitting there because it's convenient, not because it's liquid. Total inventory can look fine while deliverable inventory quietly shrinks. And if you only watch total, you'll tell yourself a comforting story right until the moment the market forces a very uncomfortable repricing. Because if this one layer tightens, the math changes. Now, why does this matter for price discovery today, this week, this month? Because futures markets are built to net exposure, not to hand everyone bars. The system works beautifully when most participants are hedging, rolling, and settling financially, when the metal is optional. But the second too many players want optionality at the same time, the second delivery starts to matter more than the convenience of paper, the whole game changes. Suddenly, the people who were happily short as part of a hedge have to make decisions on a calendar. Suddenly, the roll isn't just a routine, it's a cost. Suddenly, the spread isn't a trivial difference. It's a signal of stress. And when stress rises, price can move faster than logic. Not because logic is wrong, but because forced behavior outruns careful analysis. But that's not the scary part yet. The first place tightness speaks is the term structure, the relationship between near-month and later-month prices. In a relaxed market, the curve behaves. You might see a gentle carry. The future is a touch more expensive than spot, reflecting storage, financing, and convenience. But when the near month starts bullying the later months, when the front gets bid, and the curve compresses or flips, that's the market whispering and then shouting, "I need it now." And now is a brutal word in commodities. Now means someone is willing to pay to avoid waiting. Now means holding physical has a premium in utility. Now means rolling a short is not just a roll, it's a pain trade. And the moment rolling becomes painful, you get behavior. You get defensive positioning. You get forced buying. You get the kind of reflexivity where price rising creates more buying. Because the hedges and margin systems respond to price, not to narratives. The next detail is what flips the whole setup. Because spreads don't just tell you tight or not tight, they tell you who is being squeezed by the clock. If the front month is firming relative to the next, If the market is paying up for immediacy, someone is absorbing that cost. Sometimes it's an industrial buyer who cannot delay. Sometimes it's a short who doesn't want to deliver. Sometimes it's a fund playing calendar spreads. And sometimes it is the whole ecosystem collectively discovering that the cheapest way out is to buy back exposure rather than keep bleeding in roll costs. That's when paper starts to respect physical, not because of ideology, because of arithmetic. Now let's talk about the other signal that confuses people, vault holdings. You'll hear someone say, but London vaults are up, or total holdings aren't collapsing, as if that ends the discussion. It doesn't, because metal exists is not the same as metal is available. London can show large holdings while availability at the margin tightens, because ownership matters, form matters, location matters, encumbrance matters, willingness to sell matters. And in stressed markets, willingness to sell becomes the rarest commodity of all. If a big pool holds metal for strategic reasons, it might not come out just because price ticks higher. If bars are in one form and the market needs another, there's refining and logistics friction. If metal is sitting in the right city but tied up in the wrong hands, it's effectively illiquid. So you can absolutely see a world where headline vault totals look stable or even rising, while deliverable channels tighten, spreads firm, and price begins to move like a market that can't find enough now. And if you're not watching the right layer, you'll call the move irrational, right until it becomes obvious. But that's not the part that matters. Because the most misunderstood piece in silver, especially among smart retail investors who still get caught in the drama, is the paper to physical translation. Retail demand doesn't matter because a few people buying coins can overpower the global market. Retail matters because it pulls on a specific part of the supply chain that can bottleneck quickly. Retail demand is a form factor problem. A 1,000-ounce bar is not a monster box of coins. A bar in one vault is not an ounce in someone's hand. Turning wholesale metal into retail product takes fabrication capacity, planning, and time. Mints and fabricators can ramp, but not instantly. They have lead times. They have staffing constraints. They have blank and planche supply issues. They have distribution friction. So when retail demand accelerates, the first thing you see is not global mine supply collapsing tomorrow. The first thing you see is premiums, availability, back orders, delays. That S, the on-the-ground symptom that tells you demand is migrating from trade it to take it. And when that happens, while spreads are already hinting at tightness, the market gets nervous because it means metal is being pulled into forms and hands that are less likely to come back quickly. That's where the real pressure starts. Now, add institutional exposure to that picture, and it gets more interesting. You have vehicles that sit on massive silver exposure, and flows don't need to be dramatic to matter. They just need to be persistent. Even a steady drumbeat of accumulation changes hedging behavior. It changes how market makers manage inventory. It changes how futures participants think about deliverable risk. And it changes sentiment, not because sentiment is mystical, but because a big pool absorbing supply changes the marginal conditions of the market. And here is the key. Institutions don't have to panic buy for tightness to form. They can buy calmly, systematically, and still create a squeeze if the underlying market is already constrained at the deliverable layer. That's the part skeptics often miss. They think if there isn't a screaming headline, there isn't an institutional influence. Wrong. Quiet persistence can be louder than a headline. And then there's the options layer, because when price starts moving fast, options stop being decoration and start being a machine. Let me make this simple. When traders buy calls, the dealers who sell those calls often hedge by buying the underlying exposure. That hedge amount changes with price, delta. And when price rises, delta rises, which forces more hedging buy flow. That's reflexivity. In a calm market, it's manageable. In a thin market, it becomes a feedback loop. Add higher volatility, and hedging adjustments can get abrupt. Add key strikes, round numbers where a lot of options cluster, and the market can suddenly feel like an S being pulled uphill by a winch. That doesn't mean manipulation. It means microstructure. It means the system responds mechanically to price movement. And when the system is mechanically buying into strength, it can overshoot, then whip back, then overshoot again. The path becomes violent even if the direction is ultimately correct. That's why you need a plan that expects chaos, because the next detail is what flips the whole setup. Now we get to why now, and this is where people get lazy. Tight markets can stay tight for months. They can tease, they can frustrate, they can grind. But motion, the kind that punches through levels and doesn't apologize, usually needs a trigger. And in silver, the trigger is often not a single headline. It's a calendar window that forces actions that were previously optional. Month-end positioning, contract rolls, delivery windows, options expiries, fund rebalancing, risk books getting cleaned up. The market can ignore tightness until the calendar says, decide. Because a hedge that can be rolled next month becomes a hedge that must be rolled this week. A short that was comfortable becomes a short paying up in spreads. A fund that was neutral becomes a fund that must rebalance. That's why the market can look sleepy and then explode. Not because a magical buyer appeared, but because time removed people's ability to postpone. Time is the catalyst, and the calendar is the catalyst. And that's where the real pressure starts. Let's do a quick mental calculation, because this is where retail usually underestimates how little imbalance it takes. In a tight setup, price doesn't move to find value. It moves until the marginal buyer disappears or the marginal seller is forced to show up. That's it. If there's a wave of demand that insists on immediacy, whether industrial procurement, institutional accumulation, or retail pulling product, and if the deliverable layer is thin, the market has only a few levers. It can widen spreads to discourage immediate demand. It can raise price to ration demand. It can increase volatility to shake out weak hands. It can tighten margin requirements, which forces liquidation and relieves pressure temporarily. Notice what's missing: a lever that says, just print more silver. There's no instant supply lever. Mining is slow. Refining is constrained. Recycling responds to price, but with lags and limits. So the system uses the levers it has: price, spreads, and volatility. And if you're not expecting those levers to be used against you emotionally, you'll be the liquidity. But that's not the part that matters. What matters is how you interpret the next week or two without getting played. Because silver's favorite trick is to be right on the thesis and wrong on the path. It will pump, dump, wick both sides, and make you feel stupid for having a plan. That's why you need a viewer psychology shield right now, before you get emotionally drafted into someone else's trade. Here's how volatility manipulates you. First, it gives you a clean breakout, so you feel urgency. Then it snaps back violently, so you feel regret. Then it rips again, so you feel fear of missing out. Then it dumps again, so you feel betrayal. The goal is not just to move price. The goal is to move you out of your plan into impulsive decisions, into selling the bottom or chasing the top. And the most expensive mistake in silver isn't being wrong. It's being right and still getting shaken out by the path. So you need to separate trend signal from noise. Trend signal is structure, spreads, deliverable tightness, behavior on retests. Noise is the intraday drama that exists to harvest emotion. And if you don't separate them, the market will do it for you, and you won't like the method. Because if this one level breaks, the math changes. Now, let's talk levels, not as prophecy, but as behavioral markers. The obvious psychological zone is that $100 area, because round numbers concentrate attention, option strikes, and human bias. Above it, you tend to get acceleration, because people who dismissed the move scramble, hedges adjust, and liquidity can thin. Below it, you can get sharp pullbacks because the market loves to punish late chasers. Then you have the zones that matter for structure, areas where the move launched from, where buyers previously stepped in, where a retest would tell you whether demand is real or just momentum. In this January move, the range itself gives you anchor points. The low 70s, as the "this move started here" zone. The 80s as a likely battleground, the 90s as a psychological mid-zone, and the $100 handle as the headline magnet. You don't need perfection, you need a framework. Because the market will try to bait you into thinking one tick is truth. It isn't. Behavior around zones is truth. And that's where the real pressure starts. So here are the two scenarios you should hold in your head at the same time, because this keeps you sane and credible. Scenario 1 is the controlled pullback and retest. Price cools off. It revisits a prior zone, maybe the 90s, maybe the high or 80s, while spreads remain firm relative to what you expect in a truly relaxed market. Retail premiums don't collapse. The market doesn't suddenly find easy supply. The pullback feels like digestion, not failure. And then price stabilizes and pushes again. That scenario tells you the move is being absorbed, not rejected. It tells you the market is building a higher base. Scenario 2 is the continuation squeeze and gap risk scenario. Price holds the $100 area or reclaims it quickly after dips. Liquidity thins. You see sharper bursts, bigger candles, more gap-like behavior. The curve and spreads stay tense. Options hedging dynamics amplify moves, and anyone who is short or underhedged starts to feel margin pressure. That scenario is where the tape gets wild, and it's where people get hurt, even if they're right. Because continuation squeezes don't give you polite entries. They give you volatility. They give you air pockets. And they test your psychology, not your thesis. But that's not the part that matters. The part that matters is what would confirm or weaken the thesis in real time without you needing a conspiracy story. Confirmation. First, spreads stay tight or tighten. The front of the curve remains firm relative to the back. Deliverable availability looks stressed in the places that matter for delivery. Retail symptoms, premiums, availability, stay elevated relative to calm periods, signaling persistent pull. Institutional exposure doesn't show obvious mass exodus. And on a pullback, price finds support at a prior zone and doesn't collapse through it with ease. Weakening signals, spreads relax sharply while price still looks high. That's a huge tell because it implies immediate tightness is fading. Retail premiums collapse quickly and availability suddenly floods. Big vehicles show meaningful outflows that persist. And price loses key zones with momentum, not just wicks, especially if that happens while macro conditions shift against commodities broadly. Those are the real invalidation pressures. Not a hot take, not a tweet. Structure. Now, let's address the counterpoints, because trust is built by acknowledging what could go wrong. 1. Total vault data can be misleading in either direction. You can misread a rise as plenty or fall as shortage without understanding what portion is actually mobile and willing to sell. 2. Silver is a liquidity-sensitive asset. In a sharp risk-off event, say a sudden spike in the dollar or rates or broad deleveraging, silver can drop violently even if the physical story is still tightening under the surface. That's margin mechanics. People sell what they can, not what they want. 3. Exchanges and brokers can raise margin requirements in volatile periods. That can force liquidation and create air pockets down. That doesn't disprove tightness, it just changes the path. 4. If the move has been amplified by options hedging, expiration windows can change the flow. The same reflexivity that pushed price up can fade, and you can get a sharp mean reversion. None of that kills the thesis by itself. It just means you trade the market you have, not the market you wish existed. Because the next detail is what flips the whole setup. And here is that next detail. The market S, attempt to use volatility as a weapon, is also a signal. When a market is genuinely loose, it doesn't need to scare you. It can drift. When a market is tight and participants are uncomfortable, volatility becomes a tool. It shakes out weak longs, relieves pressure on shorts, and forces discretionary buyers to hesitate. It buys time. And time is everything in a calendar-driven squeeze. So if you see extreme wicks and violent whipsaws around key zones while spreads remain tense, that's not random. That's a stressed ecosystem trying to manage risk. Again, not a conspiracy, an incentive, a pattern. And your job is to not volunteer your emotions as collateral. So what do you watch next, specifically, over the next week or two? You watch whether the $100 handle holds as a psychological ceiling turned potential floor. You watch how price behaves if it dips into the 90s. Does it stabilize and attract bid? Or does it slice through like nobody cares? You watch for signs that front-end tightness is easing, if the curve relaxes, if spreads stop screaming, if immediacy loses its premium. You watch retail symptoms for persistence rather than one-off spikes. You watch whether institutional vehicles appear to be steadily absorbing or leaking exposure. And you watch the calendar, because month-end and roll windows don't care about your feelings. They force decisions. That's why these moves can accelerate at awkward times, in thin liquidity when the market is least forgiving. And that's where the real pressure starts. Let me say this clearly, because it's the credibility booster most people skip. Price can whip around violently even if the thesis is correct. You can be right on direction and wrong on timing. You can be right on structure and still get shaken out if you overleverage your conviction. Silver is not a market that rewards ego. It rewards risk management. So instead of anchoring to, I need it to go up today, anchor to, what would I need to see to stay confident? And what would I need to see to step aside? That's how professionals survive volatile commodities, not by being certain, by being adaptive. And here, it's the subtle community cue I will leave you with. Most people who talk about silver are either cheerleaders or cynics. They want a story, they want a villain, they want a guaranteed outcome. That's not what we do here. We follow mechanics, we follow incentives, we follow the signals that appear before the headlines catch up. We accept uncertainty, but we don't accept confusion. And if you can train yourself to watch spreads, deliverable tightness, calendar pressure, and behavior on retests, you stop being an emotional passenger, and you start reading the road. That's how you build trust in your own process, even when the market tries to weaponize volatility against you. So here's your clean takeaway, boiled down without begging you for anything. Silver AMS move isn't T-emotion, it as math. The hidden detail is deliverable tightness, not total inventory comfort. The why now trigger is the calendar forcing rolls and delivery decisions into a narrow window. The mechanism that can amplify it is reflexive hedging and short risk management when liquidity thins. Your proof stack isn't one data point. It's spreads, curve behavior, deliverable signals, supply chain bottlenecks and retail form factors, institutional persistence, and price behavior around major zones. And your roadmap is two scenarios: controlled pullback and retest versus continuation squeeze with gap risk. If spreads stay tense and pullbacks get bought at logical zones, the thesis stays alive. If spreads relax sharply and price loses key zones with momentum, respect that message. Either way, don't let the path steal your plan. Because in silver, the market doesn't just test your analysis, it tests your nervous system. The people who last are the ones who let volatility write their decisions for them.